Hey investor friends, I'm Michelle Markey, and today I'll be talking about the 100 Baggers, stocks that return 100 to 1 and how to find them by Christopher Mayer that he published in 2015. And this book talks about how you can turn $10,000 invested in a public company into $1 million by 100x, or the namesake of the book, which is 100 Bagger. So it's amazing because a lot of times many investors are happy if they can just get 10 times or a 10 bagger, but to find 100 bagger or more is an incredible feat. And Chris gives us some clues to what to look for. As you can probably tell, I'm wearing a tank with the Monster Beverage logo on it. And no, they're not sponsoring this video. I'm wearing this because they're one of the companies that reached 100 bagger status in only 9.5 years. And much like a monster, I'd love if you could please smash that like button for the YouTube algorithm, and please subscribe because it greatly helps out my YouTube channel and I greatly appreciate it, and you should help yourself to a cool monster beverage. Chris warns us about how the 365 companies is a really small sample size, and we shouldn't draw sweeping conclusions from this very unusual group that reached 100 bagger status, and only 20 of them reached the status in less than 10 years, and over 180 of them took between 16 to 30 years to reach 100 bagger status, with most of them taking around 20 to 25 years. So if you want to get 100x on a company, you might be looking at trying to hold on to that for at least 20 to 25 years. The author says you would think this strategy of buy, right, and hold would appeal to a lot more people, but he also acknowledges that a lot of people just like to gamble in a casino-like environment because it's exciting and there's lots of action. And I think that you can get a lot more attention the more active you are, but that might be living according to an outer scorecard and not necessarily according to an inner scorecard, to borrow from Warren Buffett, where your portfolio ends up revealing how you're really treating your money. If you've seen the movie News of the World with Tom Hanks, you'll understand this reference a lot more. And Chris talks about how back in the old days in the Wild West, people used to carry around coffee cans where they kept their most valuable possessions like coins and maybe jewelry or other important things. And much like in the movie, it carried coins that Tom Hanks ended up using to save his life. And you should also think about sitting on your best ideas, letting your best stocks that you want to own marinate for a long time, and you keep your most prized public companies in a coffee can to just sit there and protect. And we should strive to hold on to any securities we've bought as long as the theme or story about the company hasn't changed. And if it has, then it might be time to get out of Dodge. And then when we sell the security, it's like a confession that we made an error or a mistake. And although it's uncomfortable to live with that, it's something that we need to admit to ourselves that maybe we had the wrong judgment about the company that we bought, and then we should conduct a little bit of a lessons learned and then move on. Chris cites one of the first authors on 100 baggers named Thomas Phelps, who said that in order to make money in stocks, we need to have the vision to see them, the courage to buy them, and the patience to hold them. And he said that patience was the rarest of the three. And Chris also talks about how no amount of security analysis can tell you which companies will 100 times. It requires a little bit of vision and imagination because investing is a reductionist art. And he said that often we find that stocks didn't seem cheap based on past results alone. To reach 100 bagger status, a stock needs the twin engines of multiple growth and size growth, which refers to an increase in its price to earnings ratio, as well as an increase in its earnings per share every year. Using Monster Beverage as an example of this concept in action, the book has a chart from 2005 to 2014 showing how its PE ratio averaged 29 and its earnings per share growth rate averaged 49%. And I gathered a little bit more updated information for the years from 2005 to 2020 and found that its PE ratio actually inched up to 32, but its earnings per share growth rate averaged down to 41%. A big part of Monster's success from when they originated in the 2000s came from when they spent heavily on marketing and sales in order to get their brand known. And then once they reach economies of scale because they were on the shelves of grocery and convenience stores, they were then able to unwind a lot of costs. And with the appeal of their Bear Clawed M on their black 16-ounce cans, it's no wonder that it's a monster cash machine. And so Chris argues that the PE ratio of Monster was never out of line with its growth rate. The book emphasizes how 100-bagger companies tend to have rising return on equity, or ROE, or return on invested capital, or ROIC. And you want to see these numbers be at least 15 to 20% per year. And the higher the return on invested capital, the better. As well as we want to see top line or revenues or sales, all the same thing, be increasing at 10% per year as well. And you want to see the business recycling its profits back into growing the business, because sometimes giving out profits as dividends could be an expensive luxury where it's a drag on growth that could be preventing companies from realizing 100-bagger status. And not to mention, we should be leery of stock buybacks and no sales growth, which is what happened to IBM stock that's gone nowhere. Another case study that's shared in the book is how Amazon kept plowing its cash back into research and development, or R&D, and that's what's led it to being recognized as one of the most valuable companies, even if, according to strictly accounting figures, it may not be as obviously profitable, but clearly its stock price says otherwise. The book borrows from a Charlie Munger quote in which he said that if a business earns 18% on capital over 20 to 30 years, even if you pay an expensive looking price, you'll end up with a fine result. And the author rephrases some of that in saying we ought to pay a healthy price for a fast-growing and high-return business, much like Monster, versus paying a cheap price for a mediocre business. The book makes a great case for investing alongside owner-operators who have skin in the game, and I agree that this could be a great way to invest because these owner-operator CEOs are putting their own money on the line, and as long as they're consistently making good capital allocation decisions, then we should be able to rest assured at least a little bit while they're still in the place they're in. And we can think of some of these owner-operators, like the book says, who have vision, tenacity, and skill of people like Howard Schultz for Starbucks or Steve Jobs for Apple. Berkshire Hathaway is so special that it got its own chapter in the book because it's not only a 100-bagger, but became an 18,000-bagger. If you had invested $10,000 in it in 1965, that grew to $180 million by 2015, which is 50 years later. So it's amazing what Warren Buffett has been able to accomplish at Berkshire. And the main reason for this success is because Berkshire's in a unique position to use its premium float from its insurance customers as leverage, in that they're investing it and then they pay out claims in the future for things like car insurance claims and so on. And that's one of the most amazing reasons why Berkshire has been able to go above and beyond the rest of a lot of insurance carriers whose only choice to invest their premium float is to put it in bonds. And because Buffett has such amazing capital allocation skills, he was able to achieve that much more. The book also talks about, for the next generation of Berkshires, it's best to be a holding company or a business that has access to permanent capital from things like its operating free cash flows, unlike a fund manager who has to deal with money coming in and out from investors who may want to take out their money sometimes. So it's a much better position if you're a CEO who can make good capital allocation decisions in a holding company. There's a Buffett quote that I found is from the Wall Street Journal in 1987, where Buffett said that he can't be involved in 50 to 75 things because that's a Noah's Ark way of investing and you end up with a zoo like that. And he likes to put meaningful amounts of money in a few things. And the funny thing is, if you look at the 13F filing of Berkshire Hathaway, that has 46 stocks, as well as if you add up all of Berkshire Hathaway's 62 subsidiaries, that's getting Buffett already 108 companies. So the irony is he ended up with a zoo anyway. I like how Chris explains that when done right, stock buybacks are a modern tontine where surviving shareholders benefit the more the number of outstanding shares shrinks. The book goes a little into the Kelly formula, where F equals edge over odds, representing the percentage of how much of your bankroll to bet when you're buying a stock. because size matters if you want results. Even though sometimes it sounded like Chris was on a little bit of a rant about how we shouldn't care what the Fed is doing or what's the latest happening in the markets, he also makes a good point about how we shouldn't chase returns and we should sit still with our feet firmly planted in the ground. And this idea sort of reminds me of Jack and the Beanstalk, where if we plant our capital wisely, it'll grow to giant lengths. I appreciate how the book included the following: how it's a good idea to hold opinions loosely with a great deal of humility because there are always opportunities in all markets, and we shouldn't invest in anything that we can't illustrate with a crayon, as well as usually the stock market comes back, but not if you paid stupid prices for overpriced securities. The author also shares some insights from economist John Maynard Keynes, and I learned how Keynes was not just a 6'7" economist that everybody likes to quote, but that he was also a successful money manager for the King's College Chess Fund Endowment in Cambridge, England, and he ran that fund for several decades. Furthermore, Keynes said that as soon as you find anyone agreeing with you, you should change your mind, because if you can persuade someone to buy a share, that might be exactly the moment when we need to sell it. And then he also said his motto is be quiet, and he looked for businesses that he could buy where the intrinsic value was higher than the stock price he would pay for them. Finally, Keynes also said how he would rather own one good share than 10 bad ones. The book also features renowned investor Chuck Akre and his three-legged stool approach to investing, in which he looks for businesses that have historically compounded value per share at very high rates, highly skilled managers who have a history of treating shareholders as though they are partners, and businesses that can reinvest their free cash flow in a manner that continues to earn above average returns. And that's easier said than done. Like the book says, investing is such a mental game, and we shouldn't be afraid to hold cash in waiting for the right 100-bagger opportunities, as well as how it said cash was king during the Great Depression. If we've done things right and only bought securities after carefully studying them, the book says we should be reluctant sellers, and per Thomas Phelps, we should never sell for non-investment reasons like the price is too high or the stock's going nowhere or for tax reasons. Some noteworthy 100-baggers that have touched the lives of many consumers around the world include companies that roll off the tongue like Apple, Nike, Home Depot, Amazon, Starbucks, Microsoft, Adobe, and Monster Beverage. I'm not sure if Chris is throwing some shade, but he wrote there's no magic formula for producing 100-baggers, and we should buy right and sit tight, or hodl in Reddit speak. And if you enjoyed this video or learned something, please like and subscribe and leave a comment. I'd love to hear from you. Till next time.